Ever wondered why your loan or mortgage application keeps getting denied, even when you think your credit looks fine? What banks don't tell you could be the reason. Today, I'm breaking down the hidden factors lenders really look at, plus 5 powerful strategies that have helped thousands of borrowers go from rejection to approval, even in today's brutal market. And by the way, check out the exclusive loan link in the description below if you're ready to take action today. Because here's the truth. Banks aren't in a rush to tell you why they said no. But if you understand their playbook, you can flip the script, strengthen your application, and put yourself in the best position to finally get approved. Most people think loan approval is just about your credit score. And yes, that's part of it, but lenders actually use specialized scoring models you probably don't monitor, like the FICO mortgage score. This model weighs things like credit utilization and payment history differently than the score you see on Credit Karma. Smart borrowers know timing matters. For example, paying off your credit card balance completely, waiting a few days, and then having your lender pull your report can instantly improve your mortgage-specific score by 10 to 50 points. That's the kind of detail banks never tell you, but it can be the difference between denial and approval. Some lenders even offer something called a rapid res score, which updates your report quickly after you make changes instead of waiting 30 to 45 days. Now, let's talk about your debt-to-income ratio. This is one of the biggest hidden deal breakers in 2025. Even with a solid credit score, if your debt obligations are more than 43% of your income, most banks will flat out deny your application. Here's the catch. It's not only about paying debt down, it's about strategically improving the income side of the equation. For example, consistent side hustle income may count if documented correctly, and rental income, even from a roommate, can sometimes be used toward qualifying income. And don't forget about student loans. By restructuring into an income-driven repayment plan, borrowers have reduced payment from $600 to $250, improving their DTI enough to qualify. That's a strategy few first-time applicants know about. But here's where most people really miss out: documentation. In this market, underwriters aren't just looking at numbers, they're looking at your story. Successful borrowers present what's called a financial biography package. This means instead of just dropping in the bare minimum, you include explanations for any red flags up front, like employment gaps, unusual deposits, or past late payments. Providing 24 months of consistent bank statements or a clean rent payment history is incredibly persuasive because it builds confidence that you'll make mortgage payments on time. Lenders rarely explain this to you, but it can transform your application. Hack number 4 is what financial pros call lender matching. Most people shop for interest rates and stop there. But here's the insider truth. Every bank has its own overlay requirements. One lender may decline self-employed applicants, while another specializes in them. Some draw the line at a 680 credit score. Others will go lower with compensating factors. By mapping out 10 to 15 lenders, including credit unions, you'll discover programs banks don't advertise, like county-specific first-time buyer loans or higher debt-to-income allowances. Even simply asking a lender about their portfolio lending options shows that you're an informed borrower, and often they'll share insider programs you'd otherwise never know existed. And finally, let's talk down payments. Most buyers think it's just about how much cash they can scrape together, but in 2025, it's about strategy. Smart buyers layer funding sources like state down payment assistance programs, retirement account reserves, and documented family gifts. These combinations reduce your out-of-pocket cost while making your application appear stronger. For example, many states have grants worth $10,000 to $15,000 that don't need to be repaid if you meet certain requirements. Pair that with FHA programs as low as 5% down, and suddenly, buyers who thought they needed years to save are closing on homes now. Lenders view these layered strategies as proof of financial resilience, which can dramatically shift how your file is reviewed. So when you combine these 5 hacks, credit timing strategies, smart DTI management, documentation mastery, lender matching, and strategic down payments, you're no longer just another applicant in the pile. You're presenting yourself as the borrower banks actually want to approve. And remember, you don't have to figure it all out on your own. Check out the exclusive link in the description below to see tailored options for your situation. At the end of the day, approvals aren't just about numbers. They're about how you play the game. The banks have their rules, but when you know the insider strategies, you can work the system to your advantage. If this video gave you clarity, smash that like button, subscribe for more financial strategies, and don't forget, check the exclusive link in the description below before you apply for your next loan. Thanks for watching, and I'll see you in the next one.